All right, let's dive right into this explainer and decode the financial realities of AS4. So, what actually happens if an earthquake totally destroys your warehouse right after the financial year ends? Well, AS4 governs that tricky window right between your balance sheet date and board approval. Think of it as your ultimate survival guide for handling unpredictable contingencies and future events. First up, we gotta draw a hard line between potential financial losses and potential gains. If a loss is highly likely, say a doomed 15-lakh lawsuit, you absolutely provide for it. But contingent gains? Yeah, we ignore those entirely to avoid recording imaginary, unrealized revenue. So how exactly do we classify those crazy surprise events happening inside that approval window? Basically, every subsequent event falls neatly into one of two buckets: adjusting or non-adjusting. Let's test this out. Say a massive 5 lakh theft happens in January but stays hidden until May. Because the theft already existed before March 31st, it is 100% an adjusting event. Meaning, you've got to go back, adjust your accounts, and recognize that 5 lakh loss immediately. Right, but what about that 30 lakh earthquake disaster we talked about earlier? Since the earthquake literally didn't happen until May, it's a non-adjusting event for March. That 30 lakh loss won't change March's numbers, but it definitely requires some serious disclosure. Similarly, if you drop 100 lakhs to acquire a new company in April, what happens? It's non-adjusting. You just disclose it in the approving authority's report to keep investors informed. When you disclose these non-adjusting events, you've got to strictly follow two very precise steps. Special items, like proposed dividends, aren't liabilities yet. They're just handled as simple note disclosures. However, there is one massive, absolute exception to that non-adjusting rule we just learned. If an event totally destroys the business's core, the whole going concern assumption completely shatters. In that devastating scenario, normal accounting is out the window. You prep statements on a liquidation basis. So I'll leave you with this. How easily can tomorrow's unpredictable disaster rewrite yesterday's financial reality?